now to our exclusive interview. Mr. Lorenzo Bini Smaghi, one of the executive board members of the ECB, is here with me in Frankfurt. Sir, thank you for joining us.
Thank you.
So much concern about whether Europe will face a double-dip recession, whether growth will continue on the path. Do you expect this year to be better and better, or are we going to see headwinds to the European economy?
Well, our forecast was from the start more moderate growth than in the US, so maybe less subject to volatility. And the data that we're observing on exports are consistent. Actually, even some data even better. So we expect the second quarter to be stronger, but maybe then moderate growth. So we have to be very cautious.
So moderate growth in the third and fourth quarter,
yeah.
Or a little bit of a pickup then in the fourth quarter?
No, I think the third quarter might be less strong than the second one, but I think the data that we are having don't suggest negative numbers.
Mr. Bini Smaghi, Mr. Trichet keeps on talking about confidence. We need confidence to the markets. Will these stress tests provide the confidence that the markets are looking for?
Yeah, I think so, because in the end, markets want to know which banks are sound, and those who are not sound, what's the program, what's the plan for them. I think the stress tests will show very clearly for those banks which have problems what are the plans, what are the funds available for them to recapitalize. So I think it might take some time, but markets will get reassured.
And do you think that these tests will be credible? We've heard that, for example, for the Greek sovereign debt, it's at 17%. Is this not too soft?
You will get all the results and the assumptions, and people will be able to make their own assessment and eventually even their own adds-on test. I think, like in the US, you have to wait for the results. So it's premature to say whether they're credible or not. I think people will judge.
What is your biggest fear for the Eurozone this year?
Well, I think there are risks on the downside, like always. I think unemployment is picking up, so has peaked. So I think we have some good data there. Oil prices are stable, so that's also favorable. Banks, lending from banks is starting to pick up. We had a good number for May. It's first good number, but we have to wait. So I would say one has to be moderately optimistic that our baseline scenario will materialize.
Are you not concerned that, for example, the increase in the market interest rates will impact negatively on an already fragile economic recovery?
Which increase? The one just on the euro?
Yes.
No, but that's, I mean, really a question of markets development, which is not going to affect ultimately the interest rate that banks charge on customers. So it's a short-term market development.
Are you concerned that by giving so much liquidity on the market, central banks around the world are preparing for actually the next asset bubble?
Well, we are not seeing that right now, I would say. Central banks are trying to ease the transition from an over-indebted economy to a more stable, so it can't be too quick, but it can't be too long, otherwise you have a problem. I think we always said that we will do what is needed to avoid this. Some of the liquidity is getting out of the system automatically because the banks don't need it anymore. And if things continue as they seem to be going in the right direction, banks are getting better. So slowly this liquidity will dry out.
But is there a risk that actually central banks will have to raise rates before the economy is ready for it?
I think the stance of monetary policy is based on inflation and price stability. So that's our main concern.
Mr. Bini Smaghi, I just have one more question. Is there still opposition or split within the governing council over the continuation of the government bond purchase program?
I mean, we discuss this program every month, and we continue the program. So there's, I think we act as we have always done in a very cohesive manner.
All right, Mr. Lorenzo Bini Smaghi, thank you so much for joining us.